several countries are currently facing a shortage of foreign exchange, which has led them to take various measures to delay payment for imported goods and even restrict the import of non-essential items. Pakistan. On the brink of bankruptcy, Pakistan's economy is at risk of collapse as rolling blackouts and severe foreign exchange shortages make it difficult for businesses to operate. In 2023, Pakistan's exchange rate volatility will intensify, and it has depreciated by 22% since the beginning of the year, further pushing up the government's debt burden. As of March 3, 2023, Pakistan's official foreign exchange reserves were only $4.301 billion. Pakistan's central bank said containers full of imported goods were piling up at Pakistani ports and buyers were unable to get dollars to pay for them. Industry groups for airlines and foreign companies have warned that capital controls to protect dwindling reserves are preventing them from repatriating dollars. Turkey. Chill after the earthquake. Not long ago, the catastrophic earthquake in Turkey made the already high inflation rate continue to soar, and the latest inflation rate is still as high as 58%. In February, unprecedented cellular swarms left southeastern Turkey virtually in ruins. According to JP Morgan Chase's assessment, the earthquake caused direct economic losses of at least $25 billion, and future post-disaster reconstruction costs will be as high as $45 billion, accounting for at least 5.5% of the country's GDP. Affected by the disaster, the current domestic consumption index in Turkey has taken a sharp turn. The government's financial pressure has increased sharply, the manufacturing and export capabilities have been severely damaged, and the economic imbalance and twin deficits have become increasingly prominent. Bankers expect the authorities to take further steps to reduce foreign exchange demand. Egypt. Local currency plunge. Due to the lack of foreign exchange required for imports, since March last year, the Central Bank of Egypt has implemented a series of reform measures including currency devaluation. The Egyptian pound has lost 50% of its value over the past year. In January, Egypt was forced to turn to the International Monetary Fund for the fourth time in 6 years when $9.5 billion worth of cargo was stranded at Egyptian ports due to a foreign exchange crunch. Egypt is currently facing the worst inflation in 5 years. In March, Egypt's inflation rate exceeded 30%, so the people were quite angry. At the same time, Egyptians are increasingly relying on deferred payment services, even for relatively cheap daily necessities such as food and clothes. Argentina. Inflation breaks 100. Argentina is the third largest economy in Latin America and currently has one of the highest inflation rates in the world. On March 14 local time, according to data released by the National Institute of Statistics and Census of Argentina, the country's annual inflation rate in February has exceeded 100%. This is the first time that Argentina's inflation rate has exceeded 100% since the hyperinflation event in 1991. The rare drought in history will further worsen the expectation of Afghanistan's agricultural product exports, which in turn will have a major impact on the Afghan economy, taxation, and foreign exchange reserves. Nigeria. Currency exchange failed. Nigeria, the largest economic country in Africa, depreciated its currency naira by more than 30% last year, hitting a record low. Last year, Nigeria's inflation rate hit the highest level in the past 17 years, especially the annual increase in food prices was as high as 150%. In order to fight inflation, they came up with a big move in October last year. They hoped to absorb excess cash and control inflation. At present, there are multiple exchange rate problems in Nigeria. Import and export companies can only turn to the black market when they cannot obtain official foreign exchange quotas or the channels for foreign exchange settlement are blocked. As a result, the exchange rate of naira against the US dollar on the black market has fallen more sharply, thereby pushing down naira as a whole. Pulling, the depreciation of the local currency is accelerating and deteriorating. The foreign trade industry needs to pay attention to avoiding the risk of foreign exchange settlement, because the currency depreciation, heavy debt burden, and low foreign exchange reserves of these countries may cause failure to pay the goods on time. In order to avoid this risk, enterprises need to take a series of measures, including the following. Control exchange rate risk. Enterprises can lock the exchange rate through foreign exchange derivatives, such as futures and options, so as to reduce the risk of foreign exchange settlement. In addition, enterprises can also formulate flexible price strategies, such as implementing long-term contracts and tiered prices, to cope with exchange rate fluctuations. Ensure contract terms are reasonable. Businesses should carefully review contract terms to ensure adequate protection against exchange rate changes. When formulating a contract, the possible risk of exchange rate fluctuations should be considered and incorporated into the terms of the contract. Additionally, businesses should avoid clauses related to exchange rate fluctuations, such as payment terms that specify a specific currency. Strengthen risk management of trading partners. Enterprises need to strengthen risk management of trading partners, such as reviewing credit ratings, credit records, historical transaction records, etc. In addition, enterprises should also regularly update the information of trading partners and understand changes in international trade regulations and related policies. Choose a stable settlement method. Enterprises can choose a stable settlement method, such as letter of credit, wire transfer, etc., to reduce the risk of foreign exchange settlement. At the same time, businesses should pay close attention to the risk management measures of banks and payment service providers to ensure safe and secure transactions. In view of the current world economic environment, for shippers and freight forwarders who have a trade business with the above countries, do a good job in risk control, and beware of risks such as abandonment and non-payment by buyers at the destination port, so as to avoid losses caused by empty money and goods.